Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, people might say that we wore the same thing today, but I will point out you have on very cool shoes.
But, you know, we did this because it's aligned with the market's direction. Stocks up, bonds up.
You're right. This was completely planned. Let's get to the biggest stories right now in the more than $18 trillion global ETF industry. And we start with President Trump wanting to scrap quarterly earnings reports in favor of releases every 6 months. In just a few moments, we'll speak to Rob Arnott about the huge shift that could create. Also, a new ETF that just came to market.
Plus, we discuss the opportunities in asset-backed securities and fixed income with John Kerschner of Janus Henderson.
And it isn't just earnings reports that are in focus for the SEC. Reportedly, it's getting closer to making a decision about whether asset managers can offer ETFs as share classes of mutual funds. All of that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. The flows are a bit odd today, okay? So bear with me here. VU with $32 billion. Okay, that's not real. VU does a lot of things, but it can't take $32 billion in a week. This is rebalancing operational money moving around. My guess is VU took in its typical $2 billion and called it a day. So ignore that. SPY with $3 billion. It hasn't rebalanced yet, so that's pretty legit. And then ARK, this is interesting. This isn't rebalance flows. People have been going into ARK to get access to IPOs that ARK's able to get ahead of the market. So they're trying to feel a little that IPO pop in ARK, and then they leave afterwards. So ARK's been used for that purpose recently. IWM, again, trying to get small caps going. We'll see if the 85th time works. IEF, this is treasuries, and this is some international. And Bitcoin making an appearance again. Let's look at the outflows. And you're going to see another wild number at the top from IVV. This is $39 billion. Again, ignore it. Rebalancing. The S&P just is rebalancing, and that's that. Some money coming out of that's semiconductors, a little bit out of gold. This is leveraged Qs, leveraged Tesla. Mixed bag, I would say it leans definitely net bullish, hence the market being up. Let's look real quick about a trend that we've been following all year, which is U.S. exceptionalism. We've been pushing back on this idea that it's over. There's a lot of charts that show you this. First of all, the U.S. is beating international by about 150 percentage points over 10 years. But this year, international's made a little comeback. But here's the thing. Everybody relies on the U.S. stock market. Here's a look at everywhere in the world and how much they invest in the U.S. So here, we have 80% of our assets in U.S. ETFs. In Europe, they have half of their money in U.S.-focused ETFs. Asia, it's smaller, 11%, but growing. So a lot of the rest of the world comes over here, Katie, because equity performance is actually one of our best exports.
Yeah, it's not just a home bias. It extends globally as well. Eric, thank you. Let's keep this conversation going now with Rob Arnott. He is chairman and founder at Research Affiliates, joining us on set. Great to see you in person, Rob.
Yeah, thank you both very, very much for wearing green to celebrate the launch of our new ETF in the crowded space of cap-weighted indexing.
Well, you made my transition for me, so I thank you for that. Let's talk about this ETF that you launched last week, the Research Affiliates Cap-Weighted U.S. ETF. This tracks the Research Affiliates Cap-Weighted Index. And Rob, you made the bold claim that this could represent a new future for passive investing. Tell us about this product.
It's actually very straightforward. Cap-weighted indexing has an enormous Achilles heel. People think active versus passive. Cap-weighted indexes are passive. Yeah, they are, but no, they're not. There's 4 or 5% turnover per annum on average. So 95% of the portfolio is blissfully uncaring about whether the stocks are going up or down, whether the businesses are flourishing or floundering. And 4 to 5% is traded. That 4 to 5% is active. And boy, is it wild active. It would make Kathy Wood blush. It buys stocks at an average of twice the market multiple. It sells stocks that are deeply out of favor, unloved, and typically half the market multiple. It chases a frothy emerging growth strategy. All we're doing is saying, wait a minute, this leads to flip-flops. For every new Tesla or NVIDIA that gets found and added to the index, there's a dozen companies that come along that look super promising, that turn out to fall short of lofty expectations and crash right back out of the index in 5 to 10 years. We call these flip-flops. They do enormous damage. What if you just add a little bit of patience? You add stocks to the index when the business is big enough to matter. Not the 500 largest market cap stocks, the 500 largest businesses. And you sell stocks when their business is no longer large enough to matter. Now, if you do that, you slow down the trading, you have lower turnover, it's more passive than conventional cap-weighted indexes. And when you go back over the last 34 years, you find this really simple change boosts returns by 69 basis points per annum with about 1% tracking error. Yeah.
No, so, okay, this is RAUS, the ETF that tracks the index that would do this.
Correct.
And it is actively managed. So you're basically having a person time the market, is that right?
It is not actively managed. It is every bit as passive as the Russell 1000.
I see.
It's more passive than the S&P, which is managed by committee. It has turnover that's lower than the Russell 1000. It has turnover that's almost identical to the S&P 500, and the turnover doesn't chase fads and bubbles and doesn't bail out of a stock when it's wildly out of favor. That's where the value added comes. It is a passive strategy.
Looking at the holdings here, it looks a lot like the S&P. I mean, you've got NVIDIA, Microsoft, Apple, they're all there. Let's talk about strategy, right? This is a case where the S&P, we qualified, but the committee, who knows who they are, decided, no, we don't like it. It's also not in yours. So it's interesting there. Talk a little bit about what really is passive and what determines whether a stock gets in here, and maybe strategy is a good example. Why isn't it in here?
Well, I love your framing this in terms of active versus passive. There is no such thing as a passive portfolio. Every portfolio has turnover. That turnover can be based on rules, as at Russell. It can be based on committee decisions, as at S&P. Better to define passive as sitting placidly and going with the flow. Well, sitting placidly and going with the flow applies to 95% of the portfolio. It's also interesting that our strategy has 95% overlap with the S&P 500. 95% of the holdings are identical. The difference is at the margins. There are companies that are not yet big businesses that don't make it onto our index. Palantir is the largest market cap stock that we don't own, but it's not a big business. Trades at 100 times its annual sales. And at the other end of the spectrum, there are companies that are big businesses that aren't in the S&P because they've never been popular or frothy enough to make it into there. There's a wonderful example of flip-flops. Dillard's department store. It's been a member of the S&P 500 5 times in the last 30 years. It's been kicked out 4 times. It's come back in 4 times. Every time it's buy high, sell low. Now here's an astonishing fact. If you owned Dillard's during the 13 years in the last 35 that it wasn't in the Russell 1000, you would have made 67 times your money.
Oof.
If you owned it during the 23 years that it was in the Russell 1000, you would have made 99% negative loss. You would have a penny left of every dollar you started with. So a 6,000 to 1 ratio of wealth, owning it when it's not in the index versus owning it when it's not. Just absolutely mind-blowing.
Well, Rob, you bring up Dillard's, which is an incredible example of this, but bringing it back to, I mean, this ETF, you said it has 95% overlap with the S&P 500. So we're talking about large cap names here. How does this effect look when you think about mid caps, when you think about small caps? Do you have the same sort of flip-flopping that you might see when it comes to the S&P 500?
You do, but it's more powerful at the large cap end of the spectrum. Think of it this way. When Dillard's is not in the Russell 1000, it is in the Russell 2000. And so what we find is that every time Dillard's is added, it's added after an average of a 50% outperformance year, 5,000 basis points. Then it underperforms by an average of 6,000 basis points and gets kicked back out. Then it snaps back by an average of 210 percentage points of outperformance, 50% of that in the last year before it's added, and then it's kicked out. Lather, rinse, repeat. It's wild.
Rob, before we let you go, we got to ask you about the president's proposal. It's not official, but this idea that companies report earnings every 6 months, then every 3 months. As an investor, what do you think of something like that?
I'm a libertarian. I prefer to let people and businesses do what they want. I think a requirement of every 3 months, fine, lift the requirement. If a company wants to report every 6 months, every 12 months, that's fine. Publicly traded, it ought to report at least once in a while. But a requirement for quarterly reporting increases short-termism. I've often said that I will never, ever work for a publicly traded company again. I've been saying that for a quarter century. And the reason is regulatory distraction and short-termism. I can think about business. Rouse, the new ETF, RAUS.
Yep.
We're pricing it at 0 for the first year. The beauty in that is scale. If we get in $100 billion, multiply that by a 0 fee, and that's a lot more money than $100 million times 0, right? I'm joking. We're able to do that because we look past the coming quarter. We want to create a revolution in indexing. And if we create a revolution in indexing and it succeeds, it'll be a big moneymaker in 10 years. I don't care if it's a big moneymaker in 5 years. I certainly don't care about the first year.
Yeah, and certainly not the first 3 months. Rob, fantastic to get some time with you, as always. That is Rob Arnott of Research Affiliates talking about, of course, his new ETF, ticker RAUS. Now, coming up close to a decision, the SEC says it's on the 1 yard line for whether asset managers can offer ETFs as a share class of mutual funds. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with BlackRock, and specifically with Rick Rieder. The news coming this morning that Rick Rieder's strategy, 2 more of his mutual fund strategies, are going to convert into ETFs. We know that that team has had a lot of success with Bink. Now you have 2 active equity ETFs coming to life this morning, really to fit better into model portfolios, which we know is a huge force in this industry. Let's also talk about some interesting filings that we saw last week. This from Trump Media, proposing 5 new ETFs. They would focus on energy and defense companies. They would also focus on real estate, basically from red states there. So you can see that those filings coming through last week. It'll be interesting to see them launch. But let's talk about share classes, Scarlett, and the SEC, because we got reporting last week that the SEC is moving closer to giving its approval to the multi-share class structure. This would allow mutual funds basically to launch an ETF as a share class of an existing product, something that Vanguard had a patent on for many, many decades. But now we'll see. Maybe the SEC might greenlight other firms going ahead as well.
Sounds like they are pretty close to doing just that. Katie, let's talk more about this with James Seyffart of Bloomberg Intelligence. James, once the SEC does give its approval, and their indication to us is it's on the 1 yard line, what else needs to be done before this can move forward?
Yeah, I mean, there's a lot of back-end office work that needs to be done. I mean, all these issuers, they're working on this, right? They're getting ready and geared up. They're ready to go. I was at Future Proof last week, and this was honestly probably the top topic. This, along with tokenization, the conversations I was having with the big name issuers that have filed here, DFA, Capital Group, you name it. They're gearing up and they're ready to go to add a share class on top of their mutual funds. How long is it going to take before they actually do it? How many funds and share classes are going to come out initially? I mean, nobody actually knows the answer to that question. It's probably going to be some gap. We got some rule changes around active funds that made it a lot easier to have active ETFs. And it took months before that really started to take off. And I think this probably could be the same type of situation.
Well, James, I have to ask, I mean, you think about sort of the behind the scenes work, the plumbing of the ETF industry. Is all of that ready to go? Is that on the 1 yard line? What does that look like?
Yeah, I mean, if you think about it, Vanguard already does this, right? They have some unique situations, but Vanguard does this with their passive funds. So this is just basically really allowing other issuers to do it and to do it on active funds, which Vanguard is also going to do eventually when this is approved. So, I mean, I'm not focused on the minutia of exactly what needs to be done, but I think things are pretty much ready to go. They're ready to handle it. Honestly, this is going to be easier than converting a mutual fund to an ETF, as far as I'm concerned. That requires a lot more work in tying things in between the exchange system and the mutual fund system. Whereas this, if you're just tagging an ETF share class onto it, it's not the same. Also, we already have examples of this in Canada and Europe, so it's not like we're worried about whether or not this can be done. Like, this happens elsewhere in the world. It's just not allowed here in the U.S. yet.
Okay, James, thank you so much. James Seyffart of Bloomberg Intelligence talking to us about how the SEC is getting ever so closer to approving that change. Still ahead on ETF IQ, we're going to drill down into CLOs with John Kerschner of Janus Henderson next. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence, back with us now for today's drill down, where we focus on one ETF. Eric, what you got?
Katie, today we are looking at JABS, which is the Janus Henderson Asset-Backed Securities ETF. First time we've done asset-backed in this segment, so let's go over what it is. Basically, these are cash-flowing assets that they package together. They securitize them. Biggest ones are auto loans, credit cards, student loans. $800 billion market, and Janus is going to pick the best ones out for you. That's the premise here. 33 bips, pretty good for active, I would say. 130 million, but it's only like, I don't know, 2 months old. That's pretty good. Let's look at the holdings. Some names you'll recognize in here. There's some, infrastructure names, Hilton Grand Vacations, etc. But the idea here is you don't know much about this, so you're letting Janus pick these. And one of the big things people like about these is low correlation, low volatility, even less vol than the ag, and that produces a high Sharpe ratio, and that's really why institutions tend to like this market. Let's look at the performance of this. There really is only one other on the market that I could find, which is DABS, which is the double line. So these two are going to be going at it for the same market share. I put ag in here. It's up a little more, but these two will be more fighting for that assets. But you can see ag looks kind of volatile, and ag isn't that volatile. That's how low vol these asset-backed securities are generally, Katie, for the more sophisticated marketplace.
All right, JABS, DAGs, and AG. A lot of sounds there. Eric, thank you. Joining us to talk about this ETF is John Kerschner. He is Global Head of Securitized Products and Portfolio Manager over at Janus Henderson. Great to see you in person, John.
Yeah, thanks for having me. Always good to see you, Katie.
So JABS, this just launched, as Eric mentioned, back in July, already up to about $130 million in assets. Certainly a good number for a new ETF, but I feel like asset-backed securities, they're not as well socialized as maybe some of the other ETFs out there. So what have your early conversations sounded like with advisors, with potential investors coming into this product?
Yeah, well, currently a lot of investors obviously realize the Fed's going to cut interest rates, so they're very curious about what that means. Some people have said to us, well, we know you for JAAA, just past 25 billion. Obviously, we have a lot of investors there, but does that mean yield will go down as the Fed cuts? Obviously, it will, but it's still a very high yield for a very high quality product. But if you want something with a little more interest rate risk or duration, JABS, still very high credit quality, very similar yield at north of 5%, will get you that tailwind as the Fed starts to cut interest rates. So that's why we launched this with our partners over at Guardian Life, who have put in some seed capital as well as Janus Henderson. And that's why people are telling us they like ETFs, they like these single asset ETFs, so that's why we have JMBS, JAAA, JBBB, and now JABS.
Okay, so this fund will be better positioned if the Fed embarks on a series of rate cuts than just one single rate cut.
That's correct. Now, JAAA, again, everybody knows about it. I think it still has a place in most people's portfolios because it does give you that floating rate and diversification. But if you're sitting there saying, okay, what do Fed rate cuts mean for me? Does it mean my mortgage is going down? Maybe, maybe not, because the yield curve has been inverting. That means short rates have been coming down, long rates have been coming down too, but given what's going on with inflation, maybe not as much. So if you really want to play that, maybe you don't go into an ag, maybe you don't go into a corporate credit ETF, which are much longer duration or much longer weighted average life securities. But if you stay at the short end of the yield curve 5 years and in, this is the perfect place for you.
You know, it's interesting. I want to talk about the sophistication of the investors, because when you have something that's that low vol, a lot of times it doesn't catch the attention of retail. It doesn't stick out, but low vol plus any return means high Sharpe ratio. And you look at the holdings of JAWS, 60% of the holders have 13Fs, meaning it's big fish.
That's correct.
Right.
That's correct.
How do you sell this to the RIA in Missouri? You know, do they get into this? Is it interesting enough, or they just use the ag and call it a day?
So some of them do just use the ag and call it a day. We think that's a mistake. Obviously, you showed that return graph and how the ag actually does have a lot of volatility because it gives you a decent amount of interest rate risk. We saw that definitely in 2022. So when we're going out and talking to RIAs, we're trying to give them solutions. We talk about the world, what's going on, Fed cutting rates, inflation, tariffs, whatever it is, and then they say, I have this problem. I want to invest in fixed income. I don't want a lot of duration. I want fairly stable returns, but I want some yield. What do you have that can give me that? And that's when we talk about JAAA, that's when we talk about JABS, or maybe even JBBB if they want a little more risk.
Well, let's talk about JAAA a little bit more when it comes to the context of the rate decision that's coming up on Wednesday. It seems all but certain that we're going to see 25 basis points from the Fed. Who knows what happens after that? But JAAA, really since, not quite since its launch, but for the last few years, it's had this incredible tailwind in that it tracks floating rate securities. And it seems, again, all but certain that it's going to be dimmed a little bit.
Okay, let me ask you this. Do you know which ETF has taken in in fixed income ETF, the most AUM year to date?
Probably a cash.
SGov.
You're right, correct.
We were both.
Yeah.
20,
You were about to say
yeah,
that.
no, you guys are both spot on, so you guys get the gold star. 27, 28 billion. There's still 30 billion in cash in this country for investors. 30 trillion in cash, 7 trillion in money market funds. There is so much cash out there that people are looking for a place to put it. We still think JAAA is a great place for that. We actually think we will get more inflows because when cash is at 4%, 4.5%, people are like, well, I don't really need something else. But as
John,
you get
we
lower,
have 10 seconds left, so I have to say goodbye. Great to have you, though.
Thank you.
That is John Kerschner of Janus Henderson. That was Bloomberg ETF IQ. I'm Katie.